Okay, welcome back to Rockstock Channel. It is Monday, January 15th in the morning, and I'm wearing a Michigan hat and a Michigan shirt because I'm superstitious. I believe in karma. I'm taking my alma mater, Michigan, winning the college football national championship as a good omen, for Lithium in 2024. Rodney and I, first, though, are celebrating our 5th year anniversary of working together. I've been doing Lithium for 15 years, and Arc Equity has been in business for 20 years. But it was 2019, after Rodney and I found each other on LinkedIn and Twitter, that we decided not only to start working together, but also launching our first ever podcast, which was in January 2019. So we're going to take a stroll down memory lane a little bit in the first segment of this. Just bear with me. It'll be about a 15-minute monologue, which I find helps put things in perspective and also helps to kind of analyze where we are today and what 2024 and 2025 might look like.
Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video.
Before I begin, just want to remind everybody, if you don't already get the Lithium Ion Bull emailed to you, please go to our website, rkequity.com, register your email there, and you'll get our monthly musings in the Lithium Bull. And for these videos on Rockstock Channel on YouTube, please like, subscribe, and hit the notification bell. And if you're up for it and want some proprietary content from Rodney and I on a monthly and quarterly basis, please go to patreon.com/Rockstock Channel and look at the $10, $100, or $300 tiers. So speaking about superstition, it may be a good omen that Michigan won, but we don't know. Superstition has fooled me before. In 2020, bear market, I looked back and I looked forward and placed some faith in, the animals in the China zodiac, which served well up until last year. So I tweeted, an almost famous Lithium 2.0 Lithium Bull in 2020, where I put up the green years of 2016-17, year of the monkey and the rooster, followed by the red years in 2018 and 2019, the year of the dog and the year of the pig, appropriately named. 2020 was a transition year, the year of the rat. If you remember, COVID was first believed to stem from the wet food markets in China. But then we had Battery Day in September 2020, which set the stage for 2021's year of the ox, a raging lithium bull, which was followed by an even faster 2022 year of the tiger. Now, I had expected one more positive year in 2023's year of the rabbit, before cautiously turning to this year, 2024, the year of the dragon, and next year's year of the snake. And at the start of the year, last year, it looked like it was turning that way. Piedmont renegotiated their offtake with Tesla at market prices from Quebec rather than fixed prices from Carolina. And then LG Chem wrote them a $75 million check at $70 stock price. Winsome Resources, another Arc Equity client, following Patriot in James Bay, hit a peak price of $2.40 or so. But like many others, both of these stocks are down 60 to 70% from those early 2023 highs. In March of last year, I presented at Benchmark Minerals event in Toronto, and I talked about lithium rush, an oversupply of lithium investment opportunities, but still maintained a bullish outlook for supply, demand, and pricing. Rodney and Matt Fernley in an April video correctly called an April bottom. Spot lithium carbonate rallied 80% from April through June to a very healthy $43,000 a ton equivalent. I and TD Cowen's David Deckelbaum saw the traditional positive setup in September for a strong finish to 2023. Take it to the limit one more time was the title of a Lithium Bull following a visit to the Eagles concert in September. Matt Fernley summarized our post-summer 2023 call succinctly in his first battery materials review launched last week. Oops. In that same tweet about the China Zodiac in 2020, I referenced Sir John Templeton's famous quote about bull markets: born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Lithium Euphoria died 6 to 12 months earlier than I had anticipated, and has been displaced by a very fast and very strong pessimistic outlook, from which the seeds of the next bull market will be sown. I've been reading a lot on X about plagiarism at America's top universities, Harvard, Penn, MIT, from Bill Ackman, and the DIE philosophy, diversity, inclusion, and equity. But that won't be a subject of discussion here, except to remind our viewers and listeners of Steve Jobs famously quoting Picasso: "Good artists copy, great artists steal," which was a quote Rodney and I used to launch Lithium Ion Rocks podcast 5 years ago as the second, but not the second best, podcast focused on upstream lithium battery materials. Regular readers of mine know of my proclivity for the double entendre. Today's Rockstock recap subtitle is Peak Pessimism. Peak, P-I-Q-U-E, as a verb means to stimulate, or to feel irritated or resentful. As a noun, it means a feeling of irritation or resentment from a slight, especially to one's pride. Many lithium bulls like me, I think, can empathize with this resentment sentiment. Chatter on X and LinkedIn is filled with angst and hope of when and if we've hit bottom. But have we reached a peak, P-E-A-K, pessimism, from which the next bull market will be born? Will 2024 be a big transition year like 2020? Or will it be another year or more of pain like 2019? In our very first podcast, Rodney discussed his note: the lithium conundrum will continue in 2019. At the time, we were in year one of what would become a 2.5-year deep bear market for lithium, which began in early 2018 with Morgan Stanley and AllianceBernstein calling lithium a big short. Their analysis was loudly dismissed by many in the lithium market commentariat, but not in the equity market. Like Goldman Sachs' big bear call some 18 months ago, they were right, but for the wrong reasons. But nevertheless, they were right. As 2024 begins, we find ourselves again in a bit of a lithium conundrum. As mentioned in our year-end podcast with Mac Whale and Darko Kuzmanovic, a positive spin on spot lithium's 80% plus price decline is that it has happened so fast. So could a recovery, potentially a significant one, happen sooner? Rodney will share some current insights once I'm through with this long monologue. In our second ever podcast, I shared some bullish thoughts on Livent, and Rodney walked through his note about his top pick at the time, Ganfeng. Livent had just been spun out of FMC in an IPO on the New York Stock Exchange, and Ganfeng had recently concluded its Hong Kong IPO. Both stocks were trading well below issue price and had similar market caps of around $2 billion. For many of us licking 2023 wounds, I point to the 5-year performance on the lithium scoreboard, which is almost all green, in many instances very substantially so. Some companies up 5, 10, 20, 40 times. Ganfeng was up 5 times, but Livent has largely been flat. I remain bullish both companies over the next 5 years. As I noted in a tweet last week and in last month's Lithium Bull, I see Arcadium having scarcity value for both institutions and retail as the lithium industry's only pure play producer of size. Highly diversified in rock, brine, and DLE, vertically integrated from resource to carbonate, hydroxide, and metal, with operations in the most relevant jurisdictions and selling to the highest quality customers in China and ex-China. It's also a potential takeover target for a group like Rio Tinto, or an auto or battery OEM. I'm more bullish on Argentina than I've been in quite some time, since the time under Macri. Other players are going to be coming to the market this year, namely Eramet and the Trey Cube project that Zijin took over from Lithium. I'd like to congratulate my friends at Lithium Argentina, or Lithium Americas Argentina, as Caucharí Olaroz is now in production, and at a rate of 6,000 tons, beating their most recent 5,000 ton guidance. But again, taking a trip down memory lane, here's a slide from a deck I prepared 8 years ago when I was a strategic advisor to Western Lithium and Lithium Americas, following their sell down of 50% of Caucharí to SQM for just $25 million. The Capex turned out to be nearly $1 billion for that project, which was 2 times what was forecast in 2016. And production only started late 2023 and now into 2024, 5 years later than what I and the company was guiding in 2016. Lax Caucharí is similar vintage to Orocobre's Olaroz, which was the first new brine in Argentina for 20 years. Olaroz has had many production hiccups along the route to nameplate production capacity and battery grade, and they're still struggling a bit. Mr. Market will be watching closely whether Ganfeng, as 51% operator, will execute better. While it has long experience in carbonate conversion, this is its first foray in conventional pond construction, and brines are harder than hard rock. Initial commentary from David Deckelbaum at TD Cowen is positive in this regard. Lax trading at less than $1 billion market value, arguably at replacement value for their share of Capex and what they paid for Millennial and Arena projects. Cowen's target is $14, nearly triple the current price of $6. I've nicknamed Ganfeng both China Girl and homage to David Bowie over the years, but also as a leading indicator for when we might experience a broader lithium rally. My friends at the Swiss-based Thematica Fund put out this useful chart comparing Ganfeng to spot carbonate price, which show that Ganfeng's price has risen ahead of a rise in lithium prices. Will converters return to having the upper hand, or will spodumene producers in 2024? Might Ganfeng's higher volume offtake deal with Pilbara just announced yesterday mean slower growth and production cuts at their joint venture with Minres at Mount Marion? Rodney and I will be scrutinizing the Q4 quarterlies coming out at the end of this month and into February very closely. Will Albemarle, Arcadium, Ganfeng, SQM cut back at all on their growth Capex? Will SQM and Wesfarmers really start selling spodumene into the market in 2024 from Covalent? Will Liontown, with substantial debt, continue to push pedal to the metal spodumene spend? Looking at the January 2020 scoreboard, I'll note there was a substantial lag from the time Ganfeng anomalously rallied 57% in 2019, before the rest of the market followed in 2020 and 2021. But lithium prices fell a lot slower in the 2.5-year bear market from 2018 to 2020. Considering that lithium remains under China domination, or some believe manipulation, I believe Ganfeng again will be a leading indicator for the direction of both lithium prices and ex-China lithium producer equities. But so will Pilbara Minerals, still more than 20% short interest. And the margins for both converters and spodumene producers will reach some greater balance so both businesses can be profitable. Another major indicator will be what happens with Sigma Lithium's strategic process. Will an auto or battery maker like BYD or CATL or VW, which have been widely rumored in news articles, actually make a bid to acquire the whole company? If so, at a $3 billion plus valuation, what would this imply in terms of a long-term spodumene price assumption that BYD and CATL are factoring into their models? We think that's north of $2,000. I'm not sure that we've reached peak pessimism. Like 2019, the lithium conundrum, the bull versus bear debate, continues. The year began with downgrades of Albemarle from Evercore, and likewise from Deutsche Bank, both of which downgraded their long-term price assumptions from around $30,000 to $25,000. We may see further downgrades from Perth as the Aussies return from summer holidays next week. Uranium, on the other hand, and Bitcoin are hot. Lithium is not.
Freeberg, well, what do you got? What's your prediction for best performing asset of this coming year?
Oh, I took the uranium ETF, URA. Easy money. Whether it plays out in the next 12 months or over time, I'm not sure. It's just an inevitability.
I referenced the All In podcast, David Freeberg's call on commodities generally, and URA, the uranium ETF in particular, as being similar to Chamath Palihapitiya's call on battery metals 2 years ago, which we used as an intro to many of our 2022 videos.
What could trip up the EV revolution?
What could trip it up is it needs lithium, nickel, cobalt. You can manufacture the cars, but if you can't get the raw material components, you could be in trouble.
This would be battery metals, lithium, nickel, cobalt.
67% of my followers on X see lithium a better trade than uranium. No doubt this is a biased sample, but it reflects a lot of latent retail interest in lithium equities. But it is not reflective of peak pessimism. This is what peak pessimism looks like. March 2020, the bottom of COVID. Livent at 700 million market value. Minres 1.5 billion. Pilbara at 17 cents. Sayona and Core sub 10 million market cap with dwindling cash balances. The current market Mr. Market scoreboard does not reflect anything like such capitulation. Why can't billion-dollar valuation companies 4 to 5 years from production have to 500 million valuation? Or why can't 500 million companies become 250 million? Or 100 million valued explorers fall to 50 million or 25 million? The financing environment's going to be tough. M&A will happen, but intra-industry M&A like Albemarle Liontown seems off the cards for a period of time. In Matt Fernley's note last week, he remains wary about lithium oversupply. He, like Ken Brinsden and Benchmark and Rodney and me and others, have argued for some time that not enough investment is happening in the lithium space to keep up with EV and battery demand. And yet, despite gigawatt hours deployed being much higher in 2023 than anyone forecast in 2019, and I'm putting up a chart here of Rodney's forecast back then, lithium demand is much higher last year than it was forecast back then, but there seems to be enough lithium supply. It takes 2 years to build a battery plant. It takes 5 to 10 years to build a lithium mine. How has lithium caught up? Rodney, is the investment case for EVs and lithium still intact as you argued at the height of COVID in 2020? Is the structural deficit here to stay?
Yeah, look, Howard, the EV demand has actually exceeded my original forecasts. I think what's happened is we sort of ran ahead, and Tesla and BYD have done better than expected, and now some of the traditional OEMs are sort of cooling off a little, and everyone's kind of got ahead of themselves. But, you know, I still have a market that's going to be, you know, tight this year, possibly not so tight in 25 and 26, and then tighter again further out. But the thing that's very difficult, and we've discussed this with various players in the industry, is it's almost impossible to do a supply-demand forecast and a structural deficit out to 2030 when you don't know what the price is going to be each year. And what we saw is very clearly we accurately, along with others, projected a shortfall in the structural deficit a couple of years ago, and then lithium ran to $80 a kilo, and, you know, material came out the woodwork. And what you saw is, you know, as I said in my presentation of one-to-one, DSO, any sort of direct shipping or any low-grade material that you can just basically dig up and put on a boat is the canary in the coal mine, because that isn't a 5 to 10 year window. You can do that turnaround like you've seen in Africa and elsewhere. You can do that very quickly. That's not 5 to 10 years when all you're doing is getting a permit to dig up straight ore. So I think the dynamics change when that material becomes economic. What happens, though, is when you get to those prices, and we had that great tweet from Dwayne Sparks, and that's what I've been talking about for some time. He just put numbers to it, which was good to see when he busted down so people can see it clearly in the numbers, is when you do low-grade lepidolite, how much dirt you've got to move, what sort of impurities you're dealing with. I won't even get into the ESG, etc. And that stuff gets incentivized at a high price. And now that we're down to a China spot of 13,000 and whatever change, including VAT, that sort of material just doesn't fly, and neither does DSO. So it's a dynamic market. It's a dynamic model. It's hard to say. But what I do know is if we go lower or get peak pessimism lower that you're talking about, and there's no capital investment by the majors, M&A starts to cool off, and we start to see care and maintenance, then you sow the seeds for the next run, depending on how quickly companies can come out of care and maintenance. So the EV demand, in my opinion, is running broadly on track. I don't think people understand how aggressively China is ramping up into EVs. And Li Auto today came out with a forecast that they're aiming for 800,000 this year, up from 376,000 last year. You know, there's bright spots. BMW, you've got BYD going, and then Tesla going to ramp up Cybertruck. So we're still seeing some good things, and you've got to understand, China last year overtook Japan as the biggest exporter of autos in the world, and it's literally been like a rocket. Now, clearly some of that goes to Russia and so on. You know, there's some quirks to it, but rest of world EV sales are, you know, if I'm not mistaken, grew at triple figures. So they're still in the early adoption phase, 100% plus growth last year. So I see EVs as broadly, maybe a couple of million has come off, but that really is neither here nor there, for the end of the decade. And the structural deficit, unfortunately, is a moving target. What I do know is that the current prices, and if we go any lower, is going to set up the next bull market, but I'm hoping that we see lower highs, because then it won't, bring a whole lot of unknown material that's of poor quality and not really suited for longer term, out into the market and onto supply. So that's my broad view. I think the things to watch is, if China ramps and foreign rest of world markets are happy to take their cars, their EVs, and you have BYD and whoever setting up plants in Europe, then EV growth, sales growth could continue to be strong. The IRA, you've made mention of that. Is that going to help the US? I don't know how many cars are qualifying, but under normal conditions of not excessively high prices, the structural deficit thesis remains. It's just, if we go too high again, then, everything and anything becomes feasible, and then that threatens, that scenario.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com.
Okay, so you see, we were walking through your model yesterday, and I looked at all of the spodumene mines that were in your in your model and the brines, and you said just like tweaking, we were eyeballing 5 or 6 spodumene mines in particular that, you know, if we get some care and maintenance or some slowdown, you know, could result in what, like a 500,000 ton spodumene reduction, which would translate into what?
So practically, if everyone hits their targets, you would expect roughly a 15,000 ton oversupply of battery grade material next year, but there's about 65,000 tons equivalent of LCE in the spodumene side of things alone that I think could easily come off if we don't see a recovery in prices and you see care and maintenance and so on. Again, there are some, you know, operations that are already there that don't have big resources. Why would you stay in production to break even if you've got contract miners? So I think it makes a lot of sense.
That's like Mount Catlin you're referencing there, you know, at Arcadium,
but, you know,
like, why not preserve the value of that mine and for the higher price environment rather than deplete and make no money? Makes no sense.
So, I mean, if Western Australia, if you're using contract miners and there's a reasonably generous break clause, then, you know, why would you, you know, stay in operation and run down your resources across other, even those with bigger resources? Why would you stay in production when it's doing you no favors to run down your, you know, your resource, you know, to make no money? So I see good potential for about 65,000 tons to come off, which would put us at a 50,000 ton deficit, excluding, you know, destocking or restocking. So is the Ganfeng Pilbara deal a flag on that? Because we've seen spodumene and lepidolite production in China come off at the end of last year, and it's likely to dribble down. I don't believe, you know, the Goldman Sachs forecast that you can double the lepidolite production at $11,000 a ton, even if that's ex-VAT. I can't see that. I can't see that happening. I think the truth's going to, you know, come out there.
You've had some direct input onto the actual cost of, you know, CATL, lepidolite, and you know, our view. You know,
we had feedback in the cathode. The cathode market suggested, you know, CATL's break even's about 160,000 renminbi on their lepidolite. So
it's like 25,000 US.
No, it's. I mean, I don't know where
23,000.
23,000. Yeah. So, you know, that's kind of, you know, and as I said, we even excluding any ESG issues and what the government may have to say. So let's see where, you know, where things are at, but you can't force operators. And I've been saying this for some time is, you know, when you know, it depends how much material you've got on the pads to process. If you still need to be digging that up and then you process but you don't ship because you've got to get enough for a full shipment, there are a lot of working capital cash flows and other things to deal with, corporate overheads depending on which operation it is, and exploration and so on. You know, I think the truth of, you know, cash cost, all-in sustaining costs are very different. I don't think that a lot of operations will stay at, you know, full blown at $1,000 a ton. So I think, you know, it's gonna happen pretty quickly, and then it's a question of how long does something stay in care and maintenance, and then there's going to be a scramble, because we've been saying all along, you know, the feedstock, the Chinese domestic resources are not high quality, so they can't just fill the gap at $13,000 a ton. I don't think, you know, I think they're losing money, and people are going to back off, and then we're going to see how long people stay offline and where they come through. And you know, Albemarle, as I tweeted today, Albemarle said a while back when prices were higher they weren't at reinvestment economics. So at the current spot prices in China, obviously your contract prices are different, but I can't see that people are going to be putting money in the ground. And I think some new operations that are going to have teething issues and it's going to take time to commission and ramp are not going to go at the speeds that people thought they were. Those two, I've mentioned Liontown and Covalent, Mount Holland. Let's see how quickly they want to scramble into production at these prices.
Okay, I mean, the Q4 quarterlies are coming out in a couple of weeks. I think Pilbara starts, I think, on the 24th, so it's just 9 days from now, and they'll be followed by Albemarle. I strongly believe Albemarle will slow down their Capex spend, and if they slow down, production at Greenbushes and at Wodgina, that could have some impact. I don't know if Pilbara will follow. That they did just sign that deal with Ganfeng for some increased tonnage, which demonstrates certainly a commitment to a very good and long-term customer. Yeah, I feel like there's still more pain in the short term. We're hearing there's still kind of like a lot of supply, it's hard to discern. Albemarle was saying that, at cathode makers, at converters, there wasn't a lot of inventory, but we're hearing others, maybe this lepidolite DSO, it's still kind of in the system in China, and they can convert, they could reprocess. They just, no one I'm talking to is thinks that there's an imminent turn, but a lot of people are thinking that we got another 3 months to kind of work through. It's not just post Lunar New Year, thought process, but it is this curtailment that you're talking about needs to happen. So eyes on Arcadium, eyes on Albemarle. As I said earlier,
I think how that's going to be, because I know this is an unpopular opinion, but if you exclude the destocking, I had a slight deficit last year. So there was an oversupply. And even some of the other models, the banks, JP Morgan, I think even had the same. So in the end, there was destocking. And destocking you can only do once. So let's see.
And a lot of the destocking you're talking about was actually in cathode and in battery cells, not necessarily, in inventory at the converters.
And you saw that because you saw the amount of cells going out versus, how much, growth in cathode production and versus gigawatt hours sold. And, there was some missing link there, and also the batteries. So we will see this year. I think you're right. I think if care and maintenance, if we see a couple of operations cut back materially or go into care and maintenance, then it will be interesting to see if there's panic. And then we'll know if people are starting to scramble for material, because this is where the truth comes out, is they cannot rely on China domestic supply.
Right. The destocking that you're saying can only be done once, and the destocking, which was due to excess inventory at the cathode and the battery level, that excess cathode and battery, like the big thing that I think everybody missed, including ourselves, was not recognizing that there was not just a shortage of supply in the last cycle due to Wodgina shutting down and Altura shutting down, but there was actually an over demand in battery production in 2022 in anticipation for very substantial sales in 2023. And we did
had
have
a horrendous start, if you remember. Early 23 was a disaster, Q1, if you remember.
Everyone was hoping
the COVID very good year-on-year growth. Yeah, but if you look at year-on-year growth for this year over last year, I think China first week was 66% up year-on-year, because the beginning of 2023, the Feb was a little better, and then March, okay, but January was a complete disaster. Mm-hmm. February was a little better. So we started a year with a whole lot of inventory. Production levels were still quite high, and the sales numbers just weren't there. I mean, I knew there was some inventory building, but I assumed maybe, that the industry, if EV sales were going to be strong, could absorb some of it. But then I got feedback later on from some of the OEMs, that they had tons of inventory. So they've had to work their way through that. Now, I guess we'll know now whether that destocking is done or not pretty soon. But I think, the question is, if Chinese operators are losing money, how high can the price go and they still lose money and still keep producing? I don't think they can keep it on, keep going for indefinite.
But your argument, largely, as we've discussed in the recent days, is that we're going to see supply curtailments, which will result in price bottoming and then recovering. But what about the possibility that we could experience, like we did in 2022, in over demand, a demand surprise? I mean, what are your forecasts? And
yeah, look, I don't have a demand shock. I have a supply shock for this year. I think if we see some operations come off demand, I'm similar to Bloomberg. I think I have 22 or 23% up for EV sales and for gigawatt hours deployed, so not huge. And then might still be over 20 for next year. And then I go into the high teens. So I don't believe I have excessively high compound rate expectations. And we know that we're getting some carbon emission standard adjustments in Europe next year in 25, and then again
you mentioned that a few years ago. You were right in pointing. I remember 3-4 years ago you were so focused on that, and you said there was one year, I forget which year it was, where there was a big increase in demand, and then you said the next few years will not have that bump. But you're now saying
we did it in 2021, if you remember, and then they flatlined to 25. So I need to do a bit of work about whether the fleets are down to where they need to be, but there have been some concessions on these e-fuels. So I'd need to have a look. But the biggest issue you face in Europe is what an EV costs versus what an EV costs in China. In China, there's competitive, EVs available at cheap prices. You look at these models and you just can't believe how they can sell them at those levels. Whereas in Europe, and in the UK, which I put up in the 1-to-1, it's eye-watering what they charge for an EV.
Right.
And Germany's cut subsidies, so that's also caused, December, this EV sales dropped substantially in Germany.
Right, and Germany's being hurt, I think, by the gas prices. Again, I heard that from the
GDP growth and what have you. So it's one market, but it is a big market in Europe. But as I say, China is going well. We'll see how the US goes with more models that come out. The Volvo's got a sub $40,000 model or whatever. As more, well-priced EVs come out, I think people will be interested.
Sorry, go ahead.
China domestic and China exports into rest of world are not in any stretch of their imagination slowing down.
Mm-hmm.
They're picking up a lot of the slack.
Okay. Well, I'm here in the U.S. and the U.S. market, we have an election year. Sentiment toward, anything kind of climate EV is quite negative. I'm just looking at, posts on X. Tesla is underperforming so far year to date. And there's not been much change in the negative sentiment toward, EVs and just climate stocks generally. And in the election year, which is highly uncertain and is going to be very volatile, we need to watch it. The Iowa caucuses start, I think, tomorrow, and then New Hampshire. So there is some hope that it won't be Biden versus Trump. We'll see what other people, we'll see what unfolds there. But it's possible we'll have clarity by November. We should, and by Q4, if it's not like the market's pricing in a very negative outcome, they're pricing in that EVs are not interesting, right? Or it's going to be niche or whatever. But we have had some headwinds at the start of the year. Hertz, with their Tesla vehicles, giving back like 20,000 at low prices. You also had, you just made the point, the IRA EV incentives were very limited models, but that should could change over time because some companies will source less from China. Interest rates are still lowering, and they're considered to kind of go down further. So there's some optimism, that'll help. The Cybertruck, I think reviews are pretty good, but they're not yet scaling on that. And there's lots of talk, if Tesla launches a low-cost vehicle, that I think that could be very successful and would be very stimulative to demand. But right now, that's just speculation. The chatter is more
Howard,
likely.
I mean, if you look at all of the things, so it's the charging network. So if Tesla's opening up its charging network and opening up more chargers, that's going to, incentivize people to have a look. If you've got a lot more models that are priced below the average price of a new car in the US, like the Volvo and so on, and it gets IRA credits, that's got to be, we are moving. The one good thing about low lithium prices are we are moving to price parity between EVs and internal combustion engine, and over life of vehicle that should be tipping into EV's favor, currently or soon. It's about range anxiety and charging networks and those kind of things, I guess, is what people will need to see, because it is a big market, and the performance metrics of the Cybertruck pulling and towing against an ICE vehicle and so on, the metrics are good. So it is an important market, and it would be very helpful for lithium demand, given the size of battery packs that US EVs are going to have, to get the US market back on track.
Yeah, and right now I think market is biased negative, and until there are data points that prove otherwise, and they're prospectively there, but the market's not going to believe it. But by Q3, Q4, that there could be an upside surprise, and will we be at lower levels before we get to that more optimism? We shall see. We did hear, Rodney and I have both been having 3-4 conversations every day with lithium industry producers, executives, at development companies, some sell side analysts and some fund managers. So we're weaving together a mosaic. We have another 10 conversations set up for this week at least. So we're just kind of real time conveying, piecing together our thoughts. We'll have a lot more information, I think, again, when the Q4 results kind of come out in the next couple of weeks. That will give us a lot of information to digest. Again, if you're a Patreon subscriber, you get access to Rodney's proprietary quarterly analysis as those are coming out. We don't put those all in the public domain. So if you want to hear in real time Rodney's proprietary thoughts, please go to patreon.com/rockstockchannel. But one of the things we heard from one of the executives was that both SK Innovation and LG Chem, who have pouch cells, were struggling to some degree, with their high nickel, pouch cells for the American market. And that could be the reason why GM and Ford, have not been able to produce cars as cheaply, or as efficiently, because again, these cars are battery electric cars. The battery are the brains of the business. But the commentary there was that they're working those through, and even Mary Barra said that in her last call, that the Ultium was having some production hiccup, and hopefully we'll see more lyrics and other new products kind of come to market. She still has a full commitment. On the other hand, she's quite political, and who knows if Ford and GM are just going to wait to see the outcome of the U.S. election, and if the political winds, turn another way, they'll change course. But anyway, to the point I made earlier, 2019, you wrote the lithium conundrum will continue. I think it is still a conundrum. It's not as clear. We've been doing this a long time. Lithium was unknown when we started, and then it was on CNBC every day. for 2022, 2023. We should take those signs as, maybe toppy signs, which is why I put out that tweet about uranium as soon as I saw Pippa Stevens talking about uranium. But quite frankly, on uranium, I'm bullish. I'm still long. I don't know if I'm going to double down on my URA, but it feels like 2021, lithium in uranium, which means we have another year of positivity in uranium, if I'm right about that. And then maybe 2023, when everybody else is saying, uranium is going to be in structural deficit for 5 years, and that's everywhere, that'll be the time to sell, on the uranium score. But anyway, Rodney and I are busy noodling over a number of other initiatives we're going to, be doing this year. What I want to ask you, Rodney, just what does this overarching analysis mean for where to invest and what to invest in lithium? Should you, we just talked about, should you double down on uranium at a 52-week high, or should you average down in lithium, with stocks at 52-week lows? And which stocks and which themes, is Hard Rock in Western Australia and all the M&A activity we saw late last year, even for small projects, going to be the way to go? Or is Argentina, which we saw in 2021, had massive M&A, going to be a great place? We didn't even talk about like SQM, and we're going to be interviewing some people who have good knowledge about what's happening in Chile. But let's quickly talk about SQM and our thoughts there and where to play. Andy Leland of SC Insights made a comment, popular, ex post. But one of the components of that was he was arguing, you don't want to be in the producers, you don't want to be in the early stage explorers, you want to be in advanced stage developers, that might get bought out. That's like right in the middle of the SON curve when equities tend to not perform. Do you agree with that? So
Howard, like anything in life, you look at what's gone on in the Canadian stocks lately. So they've taken the beating of a lifetime.
Even great drill results at Azimut had fantastic drill results right where Patriot is, right where Winsome is, and the stock went down. So
it's a tough one. You've got to sift through it, and I think ultimately, like anything in life, it comes down to the individual company. Some of them are extra beaten down, some of them aren't. Some of them have money, cash in the bank. Some of them don't. I think if you are I wouldn't want to invest in a late stage developer that still needs money, because that's going to be hard to come by, as we know. So sure, we always say, do your own research. This is not investment advice. So I'd rather keep going along with that. But for my money, if you believe that on balance, through the ebbs and flows, we are going to continue to have a structural deficit, because again, we haven't spoken about it, but I think solar plus battery storage is going to be huge. And I think energy storage is still going to come out with some huge numbers that are underestimated. And China is gearing again to that market with specific form factor cells, and I think that's going to be on the upside, which may take up some of the slack from EVs. But I still, like the end of a drill bit, early stage exploration. It is what I built, early stage of my career and success on. But you do have to catch the cycles, right? Otherwise you get burnt. But for something where you are literally paying, there is no real enterprise value above cash, and you're really getting a very cheap option onto some prospective ground, that's good. We mentioned this before, some of the early exploration plays, the value started to run really high before they drilled, just on rock chip and all of these, clever announcements. But I do think if someone's got some good land and most of the market cap is in cash and they're about to drill, then there's opportunities. And if a flow through financing continues in Canada and in particular in Quebec, then you're getting a lot of bang for your buck raised to drill. So it's bizarre where Winsome is at, given that they raised all that money and they still have 60 whatever million in the bank. So you've got,
and they have to spend a great deal of it. They can't conserve it because that's what the flow through financing was used for.
Yes. So you've got an 80 million at the moment, 80 million enterprise value in Aussie dollars for 60 million tons of resource, and basically it's less than $1 million a ton, when I think it was Euros Hartley saying you should get 10 million, and I thought that was a bit rich, but 1/10 of that's quite something, regardless of whether it's JORC or 43-101 or however you want to define that resource. They've got a lot of assays still coming in that have already been done and paid for that are likely to take it to 70 anyway. So,
and size garners a premium. Size of resource garners a premium.
And Canada, in terms of clean power, cheap power, and a government in Quebec that's keen to promote battery minerals. So Brazil is also, I think, exciting. Minas Gerais is proving to be the hot area, and I'm told you can't find any land. It's all gone now. So we'll wait to see how the drill results goes. But that's what I would say. And I think for producers.
So Brazil. Sorry, before you go on to the producer, Brazil and Africa and Argentina, you have competitive tension with China. In Canada and the U.S. and Europe, that's harder. So as much as we have been supporters of ex-China supply for ex-China demand, the reality is, this is a China-dominated market. And, if CATL or BYD or VW comes into Sigma, if they get those numbers, I think that's a very important Q1 catalyst to demonstrate corporate strategic demand, because we're hearing, as much as there are a lot of people with data rooms open for spodumene supply and others, there's a lot of people who have signed NDAs, but how many are actually going to put in bids, and where are those bids, going to come in? I think we might see, actually, we shall see. Now is the time to strike, or 3 months from now, or 6 months from now is the time to strike. But I'm getting a sense that the auto OEMs, who might have gotten a lot smarter over the last few years than they were a few years ago, nevertheless are kind of like looking at the price going down, 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 and thinking, well, maybe I could just wait, or maybe I don't have to buy a mine, as everyone was advising us. So we'll see. But you were going to say about the producers.
Look, I think, Howard, if the marker that Sigma gives or what have you, if you look at my long-term lithium price, I think is in the mid-20s, ex-VAT, and spodumene, around whatever, call it 1,800 to 2,000. What is, the long-term run rate and financial ratios of someone like an Albemarle? So do I need to be cleverer than that and go into something that has the commissioning and ramp-up risk for a slight tweak, when I can be buying Albemarle on a forward multiple of sub 10 comfortably?
Right.
So
another way of saying that is, if you see Albemarle as prospectively a double, or Arcadium or Ganfeng, okay, the safe haven stock, or Pilbara for that matter, that will be the first to rally, should be the first to rally. But if you see that, even if it's 50% upside in those companies, the bar to go on a more risky scale, you need to be seeing 3-5 times your money. But you could certainly get that from a 10 million market cap explorer with $4 or $5 million in cash. That could get to 100 million.
But I'm saying that but a pre-production, or late development company, as we're seeing with inflation and costs and whatever, and ramp up issues, it's not without its perils. So I would personally want a big performance premium to take on that risk. That's just me.
Right. Or maybe they get acquired rather than be a single asset in production.
That's
company.
great. But I mean, let's be honest. I mean, guys are going to be real cautious about doing acquisitions, I think, for the next while, as they sort of just execute on their organic growth plans.
Absolutely, Albemarle is not going to be making a big bid, in my opinion. We'll see what they do with their Patriot MOU, for the downstream. But there was one last thought I wanted to say. Oh yeah, a few years ago I was talking to somebody, and we were, a sign of bullishness is that the lithium bull is bearish or not as bullish as always. But we also have, when you've had certain successes or have missed out on certain successes, like an Azure or a Winsome or a Patriot, where you've had these 10 times upside, that's highly unusual, right? A few years ago, when I first started and we were advising Western Lithium and Lithium Americas, if we can double our money in a year, we should be very happy, right? So if you could get a 50% return on an Albemarle in a year or even 2 years, or even 3 years, that's a pretty good return, right? Or so even in your favorite juniors, if you mentioned Winsome is, what do you say, 80 million enterprise value, if that goes to 160 or 250, I think that's $1 billion company at some point, but that could double or triple. But we should just ratchet down our expectations, because we had a very unusual time when lithium prices were outrageously high, and maybe they'll get back to 35, maybe they'll get to 40, maybe they'll get to 50, but we should be thinking, as we were thinking a few years ago, that lithium at $12,000 would be fantastic. You're now talking about 25,000, and yes, the costs have gone up. But
given COVID or what have you, the cost curve is absolutely blown out.
Much higher, but even if the cost curve is twice what it was back then, you could still make good money at 25,000. Is what I'm saying. Like a spodumene exploration story.
And as guys often mention, so that's where Argentina and the brines and what have you. I've always said it's just a question of ramp up time. But in terms of costing, brines are fantastic on the cost curve relative to lepidolite and carbonate. So it's just as long as the economy is stable and the politics are stable, that's great. And in the low cost,
they'll never be stable in Argentina. They'll never be stable in Argentina. But right now, the pendulum is swung to a libertarian.
As long as they can produce. And then on the hydroxide side, low cost integrated producers, in theory, the Albemarles and what have you, they should be good. Some of the others, and then of course, even if you do brine to carbonate to hydroxide, that also, if you're a low cost brine producer, by the time you do that, I believe that brine plus conversion costs can compete with even a decent integrated hard rock operation. But the gearing and the leverage, of course, sits with hard rock if things get overheated, and you can get up and running quicker, which is the question. So interesting times, but I think people need to understand that supply demand models and pricing are all very much integrated, and when prices are high, don't expect supply to come from all sorts of weird and wonderful places in a lot shorter a time frame. And when times are tough, expect capital spending like now to come off, and expect very much slowdowns in commissioning and ramping up of new projects as they try and conserve their balance sheets. Why would you just go into production for the sake of it to lose money because you said you'd do it on a certain date? You're not going to do that. You're going to wait.
Right.
So I think that's the market we're in. And then it becomes, how long does stuff with care and maintenance, and how long do projects go offline with care and maintenance? And what is the real truth on Chinese lepidolite and spodumene? What is the honest break even and cost curves of those? And can they be subsidized, if they are, or if there's some shenanigan going, how long does that last? Because it's got to be tougher and tougher as you go to the lower and lower grade, poorer quality, bigger impurity deposits. I mean, the 0.3 stuff and the 0.4 stuff, that again, it's like DSO. That stuff, shouldn't be viable.
Right. Okay. So good first interview or podcast or recap. Rodney, it's good to see you. You're in Mauritius. It's freezing cold here in New York. I, again, superstitiously am going to be optimistic given my alma mater won this year. And I don't know that there's much correlation there, but watch the elections. It's going to be a volatile year. Lithium, maybe a specialty chemical, but it is has commodity-like cyclicality, boom bust, volatility. We've said this over the many years. So I am now in year 15 in lithium promoting, and looking forward to working with you at least another 5 years, Rodney, as we ride this downturn into the next upturn.
Well, if it's still a downturn, maybe there's another 15 for you waiting.
All right. Take care.